Hello, and welcome to today's webinar, The Comprehensive Approach to Global Liquidity Management. We're glad you could join us today. Before we begin the webinar, we're going to go through a few housekeeping items as well as meet our speakers and look at today's agenda. So let's go to the webinar logistics. Today during the webinar, all attendees are in listen-only mode. If you have any questions during the webinar, please enter them in the gray GoToWebinar box on the side of your screen. We'll do our best to answer all questions during the webinar, but for those who require a lengthy answer, we'll get back to you after the webinar. If you experience any technical issues, please contact the GoToWebinar support team at 1-888-259-8414. This particular webinar does offer CTP accreditation, which you'll receive in the next several business days. As I mentioned, we'll be recording today's webinar and we'll be providing a link to both the recorded webinar as well as the slides used in today's webinar. You'll also receive that link when you receive your accreditation, so you can definitely share that with some of your team members going forward. Let's meet our presenters for today's webinar. Joining us are Priscilla Nagali from Actualize Consulting and Greg Person from Kyriba. So let's look at our agenda and learn what our presenters are going to take us through today. We're going to look at corporate liquidity. We'll look at the three-pronged approach, including working capital, intercompany, and external financing. We'll also review a case study, and we'll wrap up today's webinar again with any questions if time permits. With that, I'm going to turn it over to today's presenter, Greg Person, to start.
Great. Thank you very much, Tracy, and good afternoon, good morning for those that are joining. Thank you for joining the session today. By way of introduction, my name is Greg Person, as you saw in the previous slide. I'm the Vice President of our Global Pre-Sales team here at Kyriba. So I'm responsible for the team of consultants that are presenting, demonstrating the value and working with clients and prospects for our technology and consulting services here at Kyriba. Prior to Kyriba, I did have a career in corporate treasury. I was Director of Treasury Operations at a medical device firm called Boston Scientific, and prior to that, I was in the Global Treasury team at EMC Corporation. So for today's session, we wanted to cover in a short amount of time hopefully a comprehensive view and approach to global liquidity. So different areas I'm sure most of us on the phone are tasked with today. But to get started here, what we've done is listed a number of questions. So some basic questions that I'm sure many are familiar, perhaps some are not as familiar, to get us sort of acclimated and comfortable for today's session. So to get started here, first and foremost, when we think about liquidity, when we think about global liquidity, maybe the first place to start is, do I have visibility to my corporate liquidity? But then a second question, or very quick question after that one, is, can I access that liquidity? So we're going to focus on that question quite a bit today. Do my global subsidiaries have the liquidity they need to be successful? Do I have confidence in my global cash flow forecast, which obviously will drive various liquidity decisions and working capital decisions that I'll make for my organization? Do I have the right support, meaning do I have the right banking partners to provide liquidity for my global regions, as well as from a corporate perspective? And do I have liquidity not just from a subsidiary perspective, but also from a corporate perspective to fund those major capital, corporate expenses and different strategic items? We think about our capital allocation policies or strategies as a firm. Do we have the right liquidity in place to meet those demands of our boards, of our shareholders, and of our executive management? And finally, do I have the right technology infrastructure to support these business requirements, and also making it sensitive to my employees' time? Are we being efficient and useful with our employees' sensitive time, and also being in compliance with various tax and legal compliance and regulations, which we'll speak about a little bit later on, specifically around Reg 385 that I know many of you are focused on. Okay. But to move forward here, I guess the other area we want to at least acknowledge is that there's an ongoing balancing act, isn't there, right? So there's a lot of challenges that I, of course, remember from my years in Treasury that we see a lot with our clients, and that's that corporate liquidity balance, as we'll call it here, where there's the focus to ensure, as we learned on day one in Treasury, that preservation of capital, right? That we're preserving the asset, that sensitive cash asset on the balance sheet, but also are we taking the right level of risk from maybe longer-term investments? So that balancing act, and also from a cash on the balance sheet versus different shareholder activism, right? Do we maybe putting enough into our buyback programs, or should we be looking at a dividend or our M&A activity? More and more areas that we see for our clients, they're getting heavily involved with those decisions at a CFO and at a board level. Also from a global liquidity aspect, right? Ensuring that liquidity is available to fund those investment strategies I talked about before from a capital allocation perspective. And are we doing that at the appropriate level of risk and cost? It's very easy in some cases to keep a tremendous amount of excess cash sitting in a local account or a money market fund, but are we taking that right level of risk and cost to ensure that we're meeting the demands of our business, the demands of our shareholders, while looking for that excess yield or maybe paying down local debt or short-term debt where we can. So we'll think about that as well as we think about cash flow forecasting and thinking about short-term liquidity positioning, all things that we have to balance when we think about a global liquidity strategy. Okay. From an approach for today's session, there's really three main areas that we're going to discuss. We're going to really focus initially here from a working capital perspective, and where we're seeing a lot of focus recently of different supply chain or receivable programs to really unlock various liquidity that's in the cash conversion cycle. So we'll start in that area, and then also focus from an intercompany perspective, whether those be different types of term loans, your intercompany loans, your traditional in-house banking examples. We'll share some of those examples, and also a lot of considerations to be sensitive to, especially with the pending regulation around tax treatment for intercompany loans and intercompany in-house bank positions. So we'll speak about that as well. And then Priscilla is going to also go into quite a bit of detail around trends that we're seeing from an external financing perspective and in different types of instruments and trends in the market from that standpoint. So let's get started though really on the capital front. So as I mentioned, really what we're going to focus on here is opportunities that we have in corporate treasury to unlock liquidity, unlock cash that's tied up in working capital. So really that reduction of the cash conversion cycle, right? So there's really three areas that we can, of course, focus on if we think back to the cash conversion cycle. Really three areas that we in Treasury have the opportunity to pioneer, to champion internally within our organization to really commence these projects. That's around a days sales outstanding from a DSO perspective. So how can we collect more quickly? How can we reduce the AR on the balance sheet and collect more quickly, whether that be through a factoring or securitization program or different types of programs there. On the other side, in which I'm going to focus on in this short example today, is really on the extension of DPO, right? How can we, in a responsible way, extend our days payable outstanding, working through various programs with technology, with our banking partners, and also adding a very good tool for our suppliers to responsibly extend the DPO, which of course will increase our liquidity, improve our free cash flow, and also the inventory component. And in fact, surprisingly, we are seeing various, especially more strategic clients of ours and treasurers getting more involved in inventory decisions, right? What's the right amount of inventory, or measuring the sort of component of working capital from an inventory standpoint as well. So these are clearly areas that are not just within our treasury organization, right? These are areas that really do require some cross-functional strategic involvement. And what's I think really powerful about these programs is they have a very clear ROI. They can clearly demonstrate the liquidity, the P&L benefits from these programs, right? So as we really think about selling these programs or selling the overall value to our organizations, here's a program that is very attractive and can add real economic value to our respective organizations. And there's a lot here. These are not necessarily new programs. Certainly working with your banks and working with your technology partners can really help you articulate and find that value through working capital analysis or vendor analysis to unlock that excess liquidity in your that's tied up in your working capital today. So as I said, we're going to focus really on a supply chain finance program. And I want to start off with some kind of trends that we see or reasons why these programs do become attractive. And there's a few here. On the interest of time, I'll probably cut through a couple of these bullets. But from a corporate perspective, right, from ourselves as treasurers, right, we are often tasked with maintaining or hitting a certain cash flow target or free cash flow target. So clearly here's an opportunity to improve free cash flow, add excess free cash flow through these programs. So that's driving these kinds of programs as well. The folks on the phone here, likely you have a strong credit rating, or likely a stronger credit rating when you think about your suppliers. So you have access to credit markets and access to financing that your suppliers often don't. So there's an opportunity there to leverage your credit rating and extend that financing to your suppliers at a lower cost than they have access to independently, which is the second to last bullet, where suppliers are generally funding themselves via those more expensive working capital borrowings and at higher costs, right? And I guess the final point, which we see really globally in Europe as well, certainly in North America, is suppliers are often, face that issue with late payments, right? So if it's a larger corporate, we sometimes have that, need, or we have to hold payables or slow payables for whatever reason. That really can impact negatively our suppliers. So by instituting these programs, it really does meet a win-win-win, where we're allowing the supplier to get paid earlier, okay, at a discount rate, yes, but at a favorable rate than they could get externally at a bank. And also there's a benefit to the buyer and the bank, which I'll speak about as well. But as far as the steps, just to introduce this concept to us, and we'll see in the next slide really the value from a financial perspective. The steps for a traditional payable financing workflow is the supplier requests an early payment from the buyer, from yourself, right? So they say if we extend payment terms from 45 days to 60 days, but we say to our suppliers, you can get paid on day 10 at a 3% discount, right? So that's still a favorable rate than versus what our suppliers can get in the market independently. So what happens is the bank steps in based on that request from the supplier, pays the supplier at that discounted amount, and on the actual due date, since the payable has been satisfied from the bank to the supplier, it's now the buyer paying the bank on the full amount of the payment there to the bank on the invoice day itself. So if we think about that workflow, right, we're able to extend the payment terms with our suppliers, right? We're then able to get that influx of liquidity by going from 45 days, say 60 days as an example. So we get 15 extra days of liquidity, and we expand that across a large supplier program as a substantial influx of liquidity and free cash flow into our organization. The banks get a nice piece of business as well in these programs. As I said at the beginning as well, the supplier is paid earlier, yes, at a discount, but still at a favorable rate than they could get versus external financing on the street themselves, and they have their predictable cash flow. They're not as vulnerable or as exposed to late payments as they have been perhaps historically. So very basic, let's go through that example here, where in this scenario, the buyer receives the invoice from the supplier through a technology solution. That invoice is automatically visible to the supplier on, say, day 10. So the supplier says, I actually want to be paid early here on day 10, not wait to day 60. So again, the bank steps in, pays at that 3% discount the net amount to the supplier, so their invoice is satisfied on day 10, and then it's the buyer paying the bank on day 60 that full amount of the $100,000. So a very efficient program, a very hands-off program once these are implemented, but it does add tremendous value to the supplier, also the buyer from a free cash flow and liquidity perspective, which of course is a theme for today's presentation. Okay. The other area I want to focus on, then we'll kind of focus more on the external types of financing that we're seeing and trends that we're seeing, is around intercompany. And intercompany financing, again, is not necessarily a new trend or a new type of solution, but it's certainly a very popular one. It's often the lowest cost of financing, right? So internal cash is the cheapest form of financing. So we have a lot of excess liquidity potentially within our organizations, especially for those on the phone that come from a global organization, really trying to expose and find that those pockets of cash that probably we don't need to keep such a large cash balance in certain regions. So kind of unlocking that cash flow in the organization is an opportunity for us. We can do this through different automation, through bank pooling structures, or through different types of intercompany or in-house bank structures across multiple currencies to unlock and consolidate that liquidity at a certain legal entity. Now, there's certainly a lot of internal due diligence and initial investment that kind of goes into these programs. So we'll go through, similar to the supply chain slide, in the next slide here I'll go through another workflow more from an intercompany or in-house bank perspective. But before we get there, of course, there's a lot of due diligence, right? So collaboration with tax, with local finance, with our legal departments, making sure the documentation's in place. This is especially sensitive now as we see the rollout potentially here in the fall of the Treasury Regulation 385, which is really focused on different ways of how we treat intercompany positions, whether they should be treated as debt or as equity. So a lot still to be sorted out there, but from a documentation standpoint, ensuring we have the right interest treatment, the arm's length interest treatment in place, the demand facility agreements, the loan documentation. These are very important areas, very important to make sure we have the right legal structure, the right perhaps OUS entities in place within these programs, so we don't find ourselves in a tax or legal situation that could be expensive or could be something that we have to work to resolve internally. So a lot of due diligence goes in, but post that, once we kind of go through that due diligence, the value, right, from the automation, the ability to actually consolidate funds, to reduce those local cash balances, to again unlock that liquidity that's sitting throughout our organization, consolidate that cash at a certain pooling company or financing company internally, and then using that excess fund to be able to fund, right, those company codes, those subsidiaries who do have working capital needs by taking the excess cash in the overall pool and allocating that properly. So there's, again, tremendous value, proven value that we see across a number of clients, and I suspect many on the phone here today are also using these programs, and having the right technology in place, the right banking partners in place, the right transparency from your various subsidiaries and their cash flow forecasts and local demands really does help implement a very successful intercompany liquidity structure. So as far as, I guess, my last slide here, just to introduce an example, a fairly simplistic example, but again, you can extend this across, in your situation, perhaps dozens or if not 100+ different company codes within a global structure, how excess cash from one subsidiary can really add value to the global pool. So here is an example where my company in Singapore needs local Sing dollars to, say, pay payroll or external expense, and they're going to use that excess cash from Canada. So let's say my Canadian subsidiary here sells a certain technology and they have a $50 million receipt, so that excess cash hits their local RBC bank account, but rather than keeping that cash local, they're going to put that cash on deposit at the in-house bank company, which in my example is a company domiciled in the Netherlands called Kyriba BV, my IHB company, my in-house bank company. So they'll put that money in deposit, that $50 million. At the same time, my Singapore company needs 15 million Singapore dollar to fund that external expense, to roughly 10 million US dollar. So instead of Singapore going to their local banker, say Standard Chartered, whomever, to borrow that 10 million, they're going to go to the in-house bank company, as you can see here, to borrow that 15 million Singapore dollar. And what the in-house bank company will do, they'll simply, if there's a dollar functional, my example, they'll simply sell their position of, say, 10 million US dollar to come up with that 15 million Sing dollar, send that Singapore dollar to Singapore physically. That local cash should go to Singapore to their local account to make that external expense. And at the end of this process, they have an excess 40 million US dollar at the in-house bank company, which they can go ahead and invest externally. So that simple concept, I'm sure you can imagine how we can roll that out across several different company codes and add a lot of value and economic value and efficiency through a global liquidity project. Okay. So with that, let's switch gears a little bit, and I'll turn this over to Priscilla from Actualize Consulting, who will take us through some of the trends and areas that she's seeing with her colleagues and clients in the market today from an external financing perspective. So over to you, Priscilla.
Thank you, Greg. Hello, everyone. My name is Priscilla Nagali, and I work under the capital markets and treasury practice for Actualize Consulting. Actualize is a boutique consulting firm where we focus on enhancing operations and technology for treasury and capital markets. A lot of what we do is really helping treasuries bypass the operation status and become more strategic, and in areas such as cash visualization, liquidity management, managing exposures, being that from foreign exchange or interest rates. Prior to Actualize, I worked in banking, investment industry, and corporate treasury. So everything that we're going to discuss now in terms of liquidity are items that I often either did myself or I help clients going through that. When we're talking about external financing, obviously cost comes to mind, but also options and possibility for leverage, which is not necessarily a bad thing. Raising cash through banks, right? We can go directly to the banks. You can put line of credits in place, have structured bank loans, factoring that can be done through a bank or especially or a special financing firm. Repo, it's more of an investment firm approach for liquidity, but nonetheless very inexpensive way of raising immediate cash. When you're looking at issuing paper, you have more shorter terms such as commercial paper and asset-backed securities, or you can go to bonds. Really the path is going to be guided by if the company is an investment grade and qualify for a CP, that's often a fairly inexpensive way to raise cash as well. Or if it's below investment grade, now you see more and more asset-backed securitizations and other structured ways of raising cash and issuing paper in the market. Going to the next slide. Let's take a little bit of a deeper dive on each type of those structured finance. Obviously, given the market and how structured things can be, there are a number of opportunities out there. I'm really bringing the top of mind. Most companies do have a line of credit in place. You can either be a committed or uncommitted. The committed, you have those revolver lines where a client would pay a fee to the bank just to hold that. Given recent regulations, it is becoming a lot more difficult for banks to hold those commitments on their balance sheet. So I really wouldn't be surprised to see those rates going up. But one thing that I learned from the Treasury at Research in Motion, REM, if you guys remember them, was a big advice: do negotiate your debt when you don't need cash. So putting those lines in place and thinking about any future capital needs is definitely a wise thing to do when you're really not on the borderline and really in need of cash. When we're talking about bank loans, structured financing, it's very highly customizable. There are different ways that you can go about that. It may involve syndication, where you have few banks coming together to support the loan. It may involve requirements for collateral. In terms of duration, it can be at any point in time. It can be a short term or longer term. The risk is low from the borrower perspective. And in terms of setting it up, from an operational perspective, is not, obviously it's time consuming, but it's not as complex as if you're talking about issuing your own paper. That's where I see most treasuries taking that route, just from a comfort level of the management team. And Greg did touch a lot about working capital, and factoring is obviously a component where you can sell the receivables and raise cash in a short term. Moving forward to more, I would say, capital markets related, you have repo. So just to give a brief overview of what repo means, is really a sale of a financial asset with commitment of a repurchase. So you see companies mainly in the investment firm arena, but also companies with a significant fixed income portfolio. Repo is a very fast and easy way to raise money on the spot. You can even, get cash on the same day that you identify the need, just by settling those securities, getting that cash and holding that for a few days or whatever have been determined with the counterparty, and paying back with the interest usually to the lender. So this is a more of a short-term solution, but again a fairly straightforward and easy way to raise cash if you do hold a fixed income portfolio. When we're talking about commercial paper, very important to mention is the rating, and if you are investment grade, you would be able to assess that. Costs are very low in terms of rates, but you have to establish that, you have to set up, you have to initialize, maintain, and the risk on the CP is really around ability to roll. So you may issue at 3 months, and all of a sudden you need that extra, you need an extension, or you need to just run a roll that paper. I personally haven't seen a scenario where a client wasn't able to roll, but nonetheless worth mentioning, ability to roll on a CP. Bond issuance are the most, the go-to for both high quality and high yield companies, but I think something to mention on the bond issuance is not necessarily a bad thing, but the secondary market since the crisis has dried up significantly. So when you are probably on the investor side, when you hold that bond, it's very difficult to sell that or get rid of that throughout the life of the paper. On the other hand, if you are the borrower, you have that room to do liability management, going to those bondholders and rebuying that paper. And liability, by what I mean on liability management, is really being able to rebalance the towers, having a smoother payment schedule. A lot of companies would go on a specific events, you're going through an acquisition, you raise cash quickly, and you, let's say you're going to have an M&A, you want to issue bond, usually the sweet spot is around 10 years. So if you want to smooth that out, liability management is probably an opportunity given how secondary market is going those days. On considerations on borrowing, on the next slide, what I really, to wrap up, we only have 3 minutes left. Stop, gather the information, analyze, and negotiate. When you are considering issuing paper, you don't only have to look at internally, you have to also look externally. What is the market telling you, right? And also, what is the comfort level of management to issue paper, or and all the disclosures, compliance, covenants that come with that, acquiring the credit rating, and maintaining that relationship with the rating agencies. An important thing to mention that I've seen companies misinterpreting the meaning of liquidity. Liquidity doesn't necessarily mean cash sitting on your bank account. It's really, if you're required to have X amount of liquid cash, it's not necessarily only cash, it'll be assets. So think about, you're required to hold X amount, you can have that on a government investment or something on those lines. So don't always think liquidity being cash sitting on your account. It can be invested, and there is often interpretations for liquidity, especially on rating agencies. On our case study today, next slide please, right? Just a fairly straightforward example. That's what we see the most. It's a company that needed to raise cash for a small acquisition. They thought they would repay quickly, and the management really wasn't comfortable on going out and issuing paper. They had little visibility to international cash, so you need to take a step back, take a look at where you are, work with the tax team, regional offices, repatriate your cash, and then you have a better sense on where to go and what market to tap and how much you really need. So when you go to the table and negotiate with the bank. So this particular scenario, the client went with a 5-year LIBOR plus spread. So it's often more expensive to go that route, but if you're not looking into complexity of maintenance and operations, and if it's a one-off transaction, that might be the way to go. Just with 1 minute left, I'm just going to conclude what we talked about. we touch on different levers of liquidity, right? So my biggest advice is start with the cash forecasting. Have a good sense of where you are, not only at your office but globally too, and do tap to the different levers. A combination of that is often optimal. So, I mean, if you have any questions, I know we're at 2:30 sharp, and I will leave my email. Feel free to reach out to me if you have any questions.
Great, thank you very much. I'd like to thank both of our presenters for spending time with us today. Thank you, Priscilla, and thank you, Greg. We appreciate your expertise. And I'd like to also thank all of our attendees. We're so glad you're able to spend time with us today. We do have some additional reading for you if you'd like to follow up on this particular topic. We have a survey report from ACT and also a special report from Treasury and Risk. We will include these links in the information you get from us in the next few days, but they are also available on the Kyriba website. You can simply search for TNR report as well as survey report or ACT. Again, thank you everyone for participating in our webinar today. For those of you that appreciate the 30-minute webinar time frame, we'll actually be having a webinar next week where we're going to be talking about a topic slightly related. We'll be looking at some of the FX and hedging and compliance issues there. So we hope you can join us. Again, to find that information, you'll find it on Kyriba.com. Thank you again. Have a great rest of your day.